callers on the Gold Coast. We're going to go to Kerry now. Hi, Kerry.
Nina, hello, panel. Roger, if your call on China is correct, I think your call is 30% overvalued. But your call on AGK, thanks, Roger. Thank you.
Let me say this about China. I don't have a call on it. I'm just nervous about it. You know, very worried about it.
AGL Energy.
Yeah, like Origin, expensive. Has been for a long, long time. And today at $13.80, you know, it's no bargain. A lot of the electricity generating companies, the energy sector, don't seem to pay much attention to the valuations for very, very long periods of time. And AGL is one of those companies, like Origin. So for me, it's not an investment that has merit.
Gentlemen, I'd like to take you to an email that we received from Hayden, who's in Adelaide, who would like to get your opinion on Arrow Energy, which is stock AOE. Now, Hayden writes, good news after good news after good news over the last few weeks, and the market doesn't seem to factor this into the share price. Is there something that I am missing? So let's take a look at the chart for Arrow Energy, which is stock code AOE. There you go. So the question that Hayden's asking is there something he's missing in all of this?
Well, this is why it's really, really important to value companies. This is why it's really important to know what they're truly worth and not focus on the share price. You know, everyone's focused on the price of everything. The price of houses, the price of cars. You know, your parents used to say to you, you know, the price of everything, the value of nothing. You know, and the reality is that if the price is a lot higher than the value, then even the best news in the world might not be enough to satisfy what's needed to push the share price higher. So I suspect, and I'm just guessing here, because again, you know, the commodity sector is not something I spend a lot of time on other than Rio and BHP. I suspect that the valuation of this company is going to be a lot lower than the price. And as I go through these ones that I don't follow, like the Arrow Energies, and you know, I'm going to actually put together a list for you, and we can run through them the next time I'm on, or I can put them on the blog and people can go and have a look.
Well, Arrow Energy is one that I know a lot of callers have been interested in. Caller is Chris in Sydney. Hi, Chris.
Yeah, thanks, Nina. Nina, I just wanted to ask Roger about a stock he has spoken a fair bit about, and that is JB Hi-Fi. I bought it today at below $20, around $19.80. Would this price be close to its valuation, or have I paid too much? Thanks.
He just happens to have the paperwork in front of him, Chris.
You're supposed to ask the question before you buy it, not after. Chris, look, my valuation on this particular company now, as you know, and I've talked about it a fortnight ago, the company made its announcement, and what actually happened was they obviously, Richard Utrick announced his resignation. That was not, I think, a surprise and not a good thing. Having said that, though, businesses like this have enough momentum. You imagine throwing a ball. It doesn't matter, once the ball's left the hand, it's still got upward momentum for a while, so irrespective of who's actually driving the business, that's going to be the case. But what really was interesting from the announcement was that the payout ratio, the amount of dividends, the amount of the profit that they were paying out as dividends has increased from 50% to 60%. Now, if I've got a business that's generating a 45% return, which JB Hi-Fi is, and it's keeping 50% of the profits and it's getting 45% every year, well, that's more valuable than a company that's keeping 40% of its profits and getting 45% a year. It's paying most of it out to me. I don't want the money. I'm going to put it in my Advantage Saver account and I'm going to get 1/10% interest. And that's, by the way, that's why it's called an Advantage Saver account. It's a big advantage for the bank, right? But the reality is that this business's value has now changed. It's still going up over the next 2 or 3 years, but it's not going up as much. And so the value 2 years out is about $26.72, whereas previously it was closer to $29 or $30. Right. So the change in that payout ratio makes a big difference to the valuation further out. Now, we can't know that ahead of time. We can only plug in the information as it becomes available, and that's all I do. You know, I'm in a fortunate position of having bought the stock at $8.50 and $9, you know, so we've been talking about it ever since.
Sure have been.
But I think now the value of this business today is $19.61. Okay, that's what I think it's worth. I think it's going to be worth $23 next year, or $22.89, and $26.70, $26.72 in 2 years' time. Assuming they don't increase the payout ratio again. If they did that in the next 2 years, then that would lower the value again. The key thing about the reason I bought this business, this is an A1 business. You know, this is top quality business. There's no doubt about that. What they've done, which is remarkable, is they've entrenched their competitive advantage, which is the lowest, you know, the lowest price offer. And you can see that if you go back over the last 5 years, you'll see two things happening. You see the gross profit actually declining, and they always come out and they always say, when the gross profit goes down, the gross profit margin rather, they always come out and they always say, look, it's tough out there, we're not able to charge increased prices, prices are being, you know, coming down. What they're not saying is, we are deliberately charging less for our products so our competitors can't compete with us, and yet they're running the business on the smell of an oily rag. And if you look at the net profit margin's going up, which means as the business gets bigger, they're able to run the business on lower costs and lower prices. It's called the profit loop. Walmart does it, the Reject Shop does it, Woolworths does it, and JB Hi-Fi does it. Yeah,
it's an interesting one to take a look at. Thanks for your call, Chris. We're going to Melbourne. We've got Danny, who's been waiting. Thanks so much for your time, Danny.
Hi, I was just wondering if you had any opinion on Cooper Energy, because we were thinking of buying more, but it's not really doing that much at the moment.
Okay, what did you get in at?
What did we get in at? 60 cents.
Okay, it's currently at 50 cents. Is this one that you know much about, Owen, at all?
I'm just looking it up now. It's not one that I've been actively trading at all, no.
No, unfortunately I can't help it. What concerns me about that call, and I remember my mistake the first time I was on the show, but what concerns me is that there seems to be not enough knowledge about this company before the shares were purchased, and it's very important to actually know what you're buying before you buy and not try and work it out afterwards.
Well, that was said in a much more subtle way than what is on the
I've learned, haven't I? I've learned.
Yes. Let's go to our next caller. We've got Warren from Canberra on the line. Hi, Warren.
Yeah, hi Nina, hi panel. Could you give me a view please on BlueScope Steel?
Sure, okay, Owen, BSL stock code there, and it's currently below $2.60 by the looks of it. And we often, when we chat about BlueScope as well, Owen, we look about that and we sort of compare it to one steel as well, and if you've got a preference one over the other. But first of all, your analysis on BlueScope.
2009, obviously a shocker of a result. The problem was the capital raising they did, I think, in 2008 or early 2009.
Yeah, I think it was in 2009.
They diluted their return on equity and they diluted the equity per share, which means the value absolutely plunged. And now this is coming home to roost because there's a lot more shares on issue. I believe they used the capital that they raised to pay down debt, I think. And if that's the case, then that's always a negative because the rate of return on the equity that's raised is the interest rate on the debt. Having said that, I can be very specific about some valuations. The share price I've got here, what's the share price today?
I'll look it up for you, but...
241.
241, okay, so I did this valuation a couple of weeks ago when it was at $2.60, but that doesn't mean the value's not going to change. 2010 valuation, so the current valuation, people aren't going to like this, is 53 cents.
Oh, no.
Okay, but that's because of the dilution.
Right.
Yeah, okay, 2011, $2.20, 2012, $3. So it's trading between its valuation for 18 months out and 27 months out, or 24 months out. So it's right between the valuation a few years out. So there's not a great investment case here today. And the return on equity is currently a disaster. It's about 2.9%, going to 8.8% and 10.6%. I really want to buy businesses like JB Hi-Fi that generate return on equity of 45%. So for me, this is an investment grade.